Hello and welcome to the Harwood Report for April 23rd, 2019. I'm Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. Let's do disclosures and then I'll get into charts. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of this, then we'll start talking about the actual content. All right, basically what we're seeing right now is that the market is acting like everything is fine, which maybe it is. We're going into earnings season. The S&Ps are making new highs. Qs are making new highs. IWM is lagging. VIX is not quite at lows. Gold is drifting down as we start to see that less demand for the sort of risk hedge in the commodities land, but the commodity that's running higher is oil because global growth looks like it's better, and because, of course, we've got this conversation about Iranian sanctions. We look at fear and greed, it's at 76, it's showing extreme greed. I think that some of these things are a little bit overstated, but at the end of the day, this metric is starting to show some extreme greed. Is the chart showing extreme greed, though? You know, maybe. We're basically sitting at those highs. Maybe we need to get a little bit of consolidation up here. I mean, we did a little bit of consolidation for the week, but I don't know if that's enough. So this little burst right now is a good sign for the bull. We're getting a little further away from the 10-day moving average. We're going to let some of these other moving averages continue to catch up. It's going to take a little bit of time for the 100-day moving average to get back above the 200, but all of this stuff seems to be showing general bullish behavior. When we've seen these kind of big bursts on the breakouts in the past, we kind of consolidate a little bit and then get a little dip and then go. So I wouldn't be surprised to see a little consolidation here around this level for a couple of days. Then maybe a dip even back down towards, the 291, 292 level. It's not a big dip, just a little thing. And then that allows us to kind of set up for another round of buy the dip and rally, buy the dip and rally, buy the dip and rally. It kind of feels like 2017 all over again. Okay. When I talk about how to trade that, it's really built a little bit about, calendars and stuff that I talked about in the premium product that I put out yesterday. And part of that is because I think that we're just kind of got to get this smaller realized volatility, but the calendar kind of hedges, gives us a little bit of long Vega exposure in the case that the market kind of starts getting a little more wild. The VIX is looking like it wants to continue to drop. Yes, we had the big pull down last Wednesday on the day of settlements. It's settled, I think, at 1171 for the official settle Wednesday morning. Settlement day seems to be a day where the VIX wants to drop. Should it be above that settlement of 1171 with what we've seen over the last 4 days? Probably not. I wouldn't be surprised to see this drop down again for tomorrow's settlement, maybe down as low as 11.5. VIX wants to drop. Okay, and over time it may drop further. I kind of mentioned the tech, and tech sector's just really been leading. So when we look at QQQ, you just see that this thing is leading the way. SMH is the driver of this, of course. That's our what you might call our bull indicator, is that this thing had broken out massively, a week or so ago, and it just continues. This is getting kind of overbought in the tech sector, so I would be interested to start seeing some rotation into small caps. Small caps have lagged. You can see that they're nowhere near the all-time highs. We're still $15 away. We're still basically 10% away from all-time highs in IWM, in the small caps. Bank earnings were strong. We're seeing some money flow go into energy. Some of this stuff should start to give some benefit to the domestic names, and I'd like to see IWM play catch-up as a result. So I think that IWM is a spot where there's a little bit more leverage in the move again. Yesterday I was kind of looking more for a retest of the recent high, but with S&Ps and Qs breaking out, I'm starting to think about this as a potential breakout move here shortly as we retest that high now. So we may see rotation where S&Ps are relatively stable, Qs are stable or even a little bit weak, just getting a pullback, not a bearish setup, and IWM starts to catch some of that money flow because maybe there's some value there. TLT, bonds. We're never going to raise interest rates again. So even though the market is so bullish, TLT is not falling. So, apparently the market just really likes this setup, and the Fed likes this setup, and we're just comfortable leaving bond yields where they're at. Great. That'll help set up some consolidation and maybe a trade later. For now, I don't see a great trade. Dollar yen. When we look at dollar yen, which is my indicator on gold, it continues to trade near the highs, but it is kind of acting like it's going to top on the highs again. But at the same point, gold did fall today, as it should. It's bouncing back a little bit. Silver did fall today, as it should. So these are sort of breakdowns to the downside with bounce back afterwards. And then we see that, of course, finally, the other commodity, which is oil, the other commodity I really focus on, is just breaking out. It looks really good. And I wonder if this is part of the reason that gold and silver are bouncing back, because gold and silver get a little bit of the commodity basket allocation, even though they're very different from oil in many ways. They're still an inflation hedge. They're just more of a risk-off inflation hedge. What I want to see now, and this is where I think we've got some real potential here, is energies are starting to break out. We're above the 200-day moving average finally in XLE. OIH is the one that has been lagging the most, and this thing just can get explosive in my view. We're starting to break out here. It looks like it wants to turn this drift into more of a hockey stick formation. Maybe we get to 21 or 22 even in OIH in the next couple weeks. That gets explosive. That sets up for long calls. That sets up for something I think is really dynamic. If you want to know more about how I'm actually looking at those long calls and those calendars and things that I mentioned, you just sign up for the Harwood Report. You get a week for free, and then after that, it's only $49 a month. So it's a pretty good deal because you get that first week for free, so you can test it out. Take it for a test drive. You don't like it, you don't pay a thing. Go to tradeacademy.co/Harwood Report to sign up, and feel free to email me, Keith@tradeacademy.co, if you have any comments or questions. Thanks again, folks, and have a great rest of your trading day.